I'm Sophie Baker, the International News Editor at Pensions and Investments and the Director of Programming for the World Pension Summit. And I'm here today with Claire Lincoln, Global Head of Institutional Investor Relationships at the World Gold Council. Hello, Claire.
Hi, Sophie. Great to see you.
Lovely to see you too. So ahead of the World Pension Summit in November taking place in The Hague, we're talking to Claire. Very excited to welcome back the World Gold Council. We're going to learn a little bit more about gold, its role in institutional portfolios, and a bit more about the council itself. So Claire, can I ask you to tell us a little bit about the World Gold Council and the work you do?
Yes, absolutely. And we're really looking forward to coming back to the World Pension Summit. I think this is going to be our 7th year attending and speaking and participating. So looking forward to catching up with many people there. So who are the World Gold Council? Effectively, we're a membership organisation that is backed by gold mining companies. So right now we have more than 30 of the world's largest gold mining companies that make up our board. We were created in the late 80s, so we've been going for quite a long time now. And really a key part of what we're doing is supporting investors in their understanding of gold, ensuring that they properly understand what its core attributes are and then the role that it can play in a portfolio. So the way that I often describe us of what we're doing is that we are a resource to investors, be that data on gold, research, analytics, commentary, and then insights.
So can you tell us a bit about those attributes that you were sort of mentioning there, the kind of core attributes, and also what drives its demand? We hear so much about demand for gold and price of gold and all these things all the time.
Definitely. And these are the things to really understand at the very beginning. I think everybody has got some understanding and knowledge about gold. If you went out onto the street and surveyed people, they would probably come across and say things like, gold is a safe haven asset, gold is a commodity. And both these things are true, but we're here to really try and expand that understanding a bit more. So if I just take you through a couple of things, and that should help set the scene a bit more. So gold is a highly liquid asset. It's nobody's liability. It carries no credit risk, and it is, of course, a very scarce asset. And it benefits from diverse sources of demand in the sense that it is an investment good, it's a reserve asset used by central banks, it's jewellery, and then it also plays a role as a technology component. And we believe that an allocation to gold can enhance a portfolio in a couple of different ways, which I'd love to just take you through very quickly. So first of all, we think about how gold can and has historically delivered long-term returns for a portfolio. So if we look back over the last, say, 50 years, the price of gold in US dollars has actually increased by nearly 8% per year, which is really comparable to equities and in fact higher than bonds. And when we've looked at this at different timeframes, it's also been a similar story in a sense that gold has outperformed many major other asset classes if you took, say, the last 3 years, 5 years, 10 and 20 years. The second attribute, which is really important, and it's probably the most well-known attribute of gold, is how it can improve diversification within a portfolio. So as you know, as many investors know, effective diversifiers are sometimes quite difficult to find. And the reason for that is that many assets tend to become increasingly correlated as market uncertainty rises, and then as a consequence, volatility is more pronounced. So in that situation, many so-called diversifiers actually then fail to protect portfolios when investors actually need them the most. But with gold, it's different. So then the next question is why? Why is gold different, therefore? And the reason is because gold has a negative correlation to equities and other risk assets, which in fact increases as those assets sell off. And with very few exceptions, gold has been a really good and an effective diversifier during periods of systemic risk. So just to give you a bit of an example here, gold has generated positive returns in 8 of the 10 worst quarters of performance for the MSCI USA index. And of the remaining 2 quarters, gold outperformed the index in both cases, which helped to reduce overall portfolio losses. So that's what we talk about when we're talking about gold's role as a diversifier. And then the third attribute, which is really important to understand, and this is probably the one that investors know the least about, and that is the fact that the gold market is large, it's global, and it's really, really liquid. So again, just to put that into context, in 2023, gold's trading volumes averaged approximately $163 billion per day, which is a lot higher than something like, say, the Dow Jones index. And it's very similar to US T-bills. So there's a real scale and depth of the gold market, which means that it can therefore comfortably accommodate large buy and hold institutional investors. And in comparison to some other financial markets, gold's liquidity doesn't dry up because it really kicks in when there are, I guess, periods of financial stress in markets. So then the other aspect just to talk about is the demand drivers. And we generally break down gold's demand drivers into the following 4 categories. So they're really easy to remember: economic expansion, risk and uncertainty, opportunity cost, and then momentum. And if we just touch on very quickly as to what's happened in 2024 so far, how has gold been supported? Why has it performed the way it has? We've seen tremendous support, or ongoing support, in fact, by purchasing from central banks. They have bought so far in the year, or looking at that first half of the year's numbers, they've bought more than 480 tons of gold. We've also seen really strong retail demand from Asia, especially in China, and then of course as a consequence of ongoing geopolitical risk. So that should really sum up the attributes and a little bit around what drives the demand drivers around gold in itself.
That's what I was going to ask you as well, was around the sort of the role that gold can play in that portfolio as that kind of that bit of protection, right, around when you've got geopolitical turmoil, inflation as well. I mean, does the role that it can play differ in a defined benefit pension fund versus a defined contribution plan?
Yes, really good question. And this is something that we've done a lot of work on in the last 2 or 3 years, in the sense that now we have got bespoke case for gold for the different scheme types, because they are different in practice. You've got DB matching liabilities, and then you've got DC with more thinking about the glide path and how that should be structured. So perhaps I'll just give you a couple of high level points from the research that we've written. And perhaps I'll start with defined benefit. So what do we think, or how do we think gold can play a role within defined benefit pension schemes? So we look at the following things. And this is all based on research and on analysis that we've carried out by taking model portfolios that are publicly available, and we've kind of taken out some assets and then introduced gold generally at a 5% level. So we think on the DB side that based on the analysis we've carried out, that gold can contribute to long-term growth of a portfolio, a pension portfolio specifically, and therefore help to reduce the worst outcomes that portfolio may experience. We've also looked at the way that gold can help to reduce funding level volatility within a DB scheme by being an effective diversifier. We've looked at the ways that by introducing an allocation, it can protect against downside risk. And then lastly, it's really enhancing that portfolio's overall liquidity, which could help to meet short-term cash flow requirements in times of market stress. And we can all remember a period not so long ago where many of those schemes, were really struggling with liquidity challenges. So that kind of reviews a little bit of the work that we've done on the DB side. When it comes to DC, and this also can be extended for, large size DC schemes, in particular in the UK, for the master trusts. When it comes to, I think, the more traditional DC investment portfolio made up of equities and bonds, even though they did make a bit of a comeback last year, delivering returns that we've not seen for a while, but there are still many, I think, challenges that those types of portfolios face. One being ongoing inflation volatility risk, and of course a highly uncertain economic backdrop. And if you think about the way that, I guess, DC schemes have been using diversifiers in the past, it's often been government bonds that have been, where they've gone to. And they have often fulfilled the role of being a good diversifier. But now that we're in a slightly different environment, that value proposition that fixed income has offered in the past has weakened due to the fact that now we've got positive correlations with equity. So again, just trying to back this up with some of the work that we've carried out here and the analysis that we've done, a key takeaway for us was that a portfolio following a glide path that had gold in it could actually provide a more secure income in retirement, because it helps to mitigate, some of those key risks that those investors face, which is namely investment risk, inflation risk, and then longevity risk. So if this has caught anybody's attention, or people are thinking about wanting to learn a bit more, they can simply head to our website, which is called goldhub.com, and they'll find the various reports that we've written, which also includes looking at the role of gold in Australian superannuation schemes. So there's a lot of content out there.
Absolutely, and we are seeing it more sort of pop up in strategic placings as well, and sort of strategic ideas and thought leadership too. I've certainly noticed that over the last few months. So definitely one to be watching. Amazing. Well, Claire, can't wait to see you in The Hague in a few short months. And Claire will be moderating our opening investment panel, an all-female CIO panel, which I'm very excited about.
Me too.
It would be excellent. And but thank you so much for going through this. This has been your expert interview. I hope you enjoyed it, and we will see you in The Hague.
Thanks, Sophie. See you soon.
Thank you.